Welcome back, financial warriors. You've reached the grand finale for a blockbuster series that will help you improve your financial IQ. You've come this far, and now it's time to unlock the ultimate secrets to financial mastery. In the first two parts, we've delved deep into the realms of personal finance, uncovering strategies and igniting your financial intelligence. Now in this epic conclusion, we're revealing the final 5 game-changing techniques that will elevate your financial IQ to extraordinary heights. If you missed out on the first 2 videos, don't worry, we've got you covered. Click the links in the description or the cards popping up on the screen to catch up on the invaluable insights you need for a prosperous future.
Welcome to the General Finance channel, where we're committed to helping you take control of your finances. Are you tired of feeling overwhelmed by credit card debt, unsure of how to create a budget, or intimidated by the world of investing? Don't worry, we've got you covered. Our channel is dedicated to providing you with practical tips and insights on credit management, budgeting, and investing. We upload new videos 3 to 5 times per week, so you'll always have fresh and valuable content to help you achieve your financial goals. If you like what you see, make sure to hit the like and subscribe button, as well as the notification bell so you never miss out on our latest uploads. Let's start our journey to financial freedom together right here on General Finance.
Number 1. Decode behavioral finance. Behavioral finance is a field of study that combines principles from psychology and economics to understand how cognitive and emotional factors influence financial decisions and market outcomes. It recognizes that individuals are not always rational and make decisions that deviate from traditional economic models. Decoding behavioral finance can be immensely beneficial in managing your finances because it helps you identify and overcome biases that could negatively impact your financial decisions. Let's explore some key concepts in behavioral finance. Overconfidence. People tend to be overly confident in their abilities and may overestimate the accuracy of their predictions or investment performance. Confirmation bias. This bias leads individuals to seek information that confirms their existing beliefs and overlook contradictory evidence, potentially leading to suboptimal decisions. Loss aversion. The fear of losses can lead individuals to make risk-averse choices and miss out on potentially lucrative investment opportunities. Anchoring. Individuals often rely too heavily on initial pieces of information when making decisions, even when new information suggests a different course of action. Herd mentality. People tend to follow the crowd and base their decisions on the actions of others, which can lead to market bubbles or panics. Mental accounting. Individuals compartmentalize their money into different mental accounts, treating each account differently and potentially making irrational financial choices. Recency bias. Recent events and experiences have a stronger influence on decision-making than long-term trends or historical data. To decode behavioral finance and overcome these biases, increasing self-awareness is crucial. Recognize your own tendencies and biases and actively challenge them. Seek diverse perspectives and opinions to avoid falling into confirmation bias or herd mentality. Implement disciplined investment strategies that align with your long-term financial goals rather than making impulsive decisions based on short-term market fluctuations. Number 2. Study the Financial Independence, Retire Early FIRE principles. The Financial Independence Retire Early, or FIRE principle, is a personal finance movement that emphasizes achieving financial independence at an early age, allowing individuals to retire and pursue their desired lifestyle without being dependent on traditional employment. The core idea of the FIRE principle is to save and invest a significant portion of your income to accumulate enough wealth and generate passive income streams that can cover your expenses. To achieve financial independence and retire early, one of the key strategies is maintaining a high savings rate. This involves living below your means and saving a substantial portion of your income. By keeping expenses in check and prioritizing savings, you can accumulate wealth at a faster pace. This requires careful budgeting, frugality, and making conscious decisions about spending. In addition to a high savings rate, diversifying your portfolio is crucial for achieving financial independence. This involves spreading your investments across different asset classes such as stocks, bonds, real estate, and potentially other income-generating assets. Diversification helps reduce risk by not putting all your eggs in one basket. It allows you to benefit from different market conditions and potentially higher returns while mitigating the impact of market fluctuations. Achieving financial independence and retiring early requires discipline, long-term planning, and a strong commitment to your financial goals. It involves making informed investment decisions, maximizing your earning potential, and continuously monitoring and adjusting your financial strategy. It's important to know that FIRE is not necessarily about completely stopping work, but having the freedom to choose how and when you work, pursuing passion projects, or engaging in meaningful activities without financial constraints. Number 3. Implement zero-based budgeting. Zero-based budgeting is a budgeting technique that involves starting from scratch and reevaluating all expenses from zero, rather than relying on past spending patterns. Unlike conventional budgeting techniques, which often involve making incremental adjustments to previous budgets, zero-based budgeting requires individuals to justify every expense and allocate their income based on their current needs and priorities. By adopting this approach, individuals are able to take a more proactive and intentional approach to their financial planning. To implement zero-based budgeting, you can begin by enumerating all your monthly income sources, including your salary, side hustle earnings, and any passive income streams. Next, you should itemize all your expenses, listing both fixed expenses such as rent, utilities, and loan payments, as well as variable expenses like groceries, transportation, and entertainment. It's important to include savings and investments as expenses as well, as they are crucial for achieving your financial goals. Once you have a clear view of your income and expenses, you can prioritize and allocate your income accordingly. Start by covering your essential expenses, such as housing and utilities, followed by allocating funds for savings and investments. Finally, allocate remaining funds for discretionary spending. This approach allows you to align your spending with your financial goals and make deliberate choices about where your money goes. Regular monitoring and adjustments are essential in zero-based budgeting. By regularly reviewing your spending and comparing it to your budget, you can identify areas where you may need to make adjustments or cut back on expenses. This enables you to stay on track with your financial goals and make informed decisions about your money. Number 4. Experiment with dollar cost averaging. Dollar cost averaging, or DCA, is an investment strategy where an investor systematically invests a fixed amount of money into a particular investment at regular intervals, regardless of the market price. With DCA, the investor buys more shares or units when prices are low and fewer shares or units when prices are high. This strategy allows investors to spread their investment over time and helps reduce the impact of market volatility. DCA helps mitigate risk by taking advantage of market fluctuations. When prices are high, the fixed investment amount buys fewer shares, and when prices are low, the fixed investment amount buys more shares. Over time, this averaging effect can result in a lower average cost per share compared to making a lump sum investment. By investing regularly, regardless of market conditions, DCA helps smooth out the impact of short-term price fluctuations. One of the key advantages of DCA is that it helps investors overcome the psychological barriers that can hinder successful investing. Emotions such as fear and greed often lead investors to make irrational decisions, such as trying to time the market or making impulsive buy or sell decisions based on short-term market movements. DCA removes the need for trying to time the market, as investments are made at regular intervals regardless of market conditions. This helps investors avoid the temptation of trying to predict short-term market movements and makes investing a more disciplined and systematic process. Additionally, DCA allows investors to take advantage of a strategy known as buying on the dips. When market prices are low, DCA encourages investors to buy more shares at a lower cost, potentially benefiting from the market's eventual recovery. This approach aligns with the principle of buying low and selling high, and it can lead to favorable long-term investment outcomes. It's worth noting that DCA is not a guaranteed strategy for generating profits or avoiding losses. Market conditions and the performance of the specific investment will ultimately determine the outcome. However, DCA provides a systematic and disciplined approach to investing that can help reduce the impact of market volatility and mitigate risk over the long term. Number 5. Follow influential financial podcast. Watching or listening to influential financial podcasts is a great method to elevate your financial IQ, as they offer invaluable insights and expert perspectives on various facets of finance. Podcasts provide a convenient and readily available source of information that you can listen to during your leisure time, making it easy to stay updated on market trends and personal finance topics. One of the significant advantages of financial podcasts is that they often invite and interview people who are wealthy and successful in the financial industry. These guests share their experiences, strategies, and financial tips, providing you with first-hand knowledge and insights into their success. By listening to their stories and advice, you can gain valuable lessons, understand different investment approaches, and learn about financial management techniques that can help you increase your financial IQ. Financial podcasts cover a wide range of topics, including investing, entrepreneurship, personal finance, wealth management, and market analysis. The hosts and guests on these podcasts are experts in their respective fields, offering a diverse range of perspectives and expertise. This exposure to different viewpoints can expand your understanding of finance and expose you to new ideas and strategies. Moreover, podcasts allow you to learn at your own pace and on your own schedule. Whether you're commuting, exercising, or relaxing at home, you can tune in to financial podcasts and absorb valuable information. This flexibility ensures that you can fit financial education into your busy lifestyle without disrupting your routine. Listening to influential financial podcasts also helps you stay informed about current market trends, economic news, and developments in the financial industry. Hosts often discuss timely topics, analyze market movements, and share insights on potential investment opportunities. This knowledge can empower you to make more informed financial decisions and capitalize on emerging trends. Congratulations, financial superstars! You've reached the exhilarating finale for our financial series. You've come a long way, and we're thrilled to have been a part of your financial journey. But guess what? This is just the beginning. If you haven't watched the first 2 parts yet, don't worry. You can find them in the description or by clicking the cards on the screen. Now get ready for what lies ahead. We have an incredible lineup of future videos planned, filled with cutting-edge insights, expert interviews, and game-changing ideas that will take your financial IQ to new heights.
Thanks for tuning in to today's video on the General Finance channel. We hope you found it informative and valuable. Remember, we'll be posting new videos on the channel 3 to 5 times per week, so make sure to hit that subscribe button and turn on notifications so you never miss an update. And don't forget, we want to hear from you. Leave your thoughts and feedback in the comments section below. Is there a particular topic you'd like us to cover in a future video? Let us know. Thanks again for watching, and we'll see you in the next one. Keep building that financial savvy, and we'll be here every step of the way to help you on your journey to financial freedom.